This video looks at asset classes. You should also see the video on compounding. Then finally see the video on investing in funds for discussion on risk and diversification and working with financial advisors to set appropriate goals and levels of risk for your investments. There are 4 main asset classes and 3 minor ones. Let's make a start with cash. Cash. It's held in banks or building societies, or on platforms, or even held in a safe. Advantages: readily accessible, liquid and accepted anywhere. Easy to move. Provides a return in the form of interest. First £85,000 per person per banking licence is protected by the Financial Services Compensation Scheme. Above that, there is no guaranteed protection. Cash held within the FSCS protection limits is low risk and low return. Cash held on platforms is notionally held across a minimum of 4 separate banks, so larger amounts of cash may be safer here. Disadvantages: interest rates are at historic lows and likely to remain so. Allowing for inflation, there is a negative real return, so if you receive 2% but the cost of living has risen 3%, in real terms your money has lost purchasing power. You received a nominal return of 2%, but a real or inflation-adjusted loss of 1%. Over the long term, cash loses value as prices rise faster. There is no growth potential, unless asset prices are falling in a deflationary environment, in which case the purchasing power of cash increases. This is infrequent and unlikely to last long when it does occur, as governments hate deflation. All policy attempts are always towards inflation, not deflation. This is useful investing information. Features of cash: it is not volatile, so you may sleep easier at night. You are not worried about performance. No growth potential, so suitable for older people, but not for young investors. Useful to have cash in reserve when other asset prices have fallen, to buy them at a lower price. There's always a risk of banks collapsing or hyperinflation destroying its value. It is far from risk-free. Bonds. Bonds are debt issued by governments or companies. You are lending your money to them for a return called the coupon, which is interest. They issue this debt because it may be cheaper than borrowing from the banks. After the term of the bond, your capital is returned. Advantages: the nominal returns are fixed, hence the name fixed income. You know what you are getting. There is not much volatility, usually liquid and easy to sell. Usually offer a higher return than cash. Now easier to buy corporate bonds on the London Stock Exchange's ORB platform. Disadvantages: like cash, inflation can reduce the real return. Government bonds are very safe because they can repay you by printing money, but sovereign nations have defaulted in the past, for example Argentina. The issuer can miss paying coupons, so if a company suffers it can also default on its corporate bond. They are regarded as a safer investment, but you still have the possibility of losing all your capital. Ratings agencies allocate credit ratings. For example, a AAA rating would indicate very low risk of default, but junk bond status would be very high risk. But can you trust the ratings agencies? They were asleep at the wheel in 2007, when many banks were technically insolvent. Still, a portfolio of bonds can offer geographical diversification and good spread of risk, and so may be regarded as low risk, with higher returns than cash. There is potential for growth, but it is very low. Do not confuse bonds with investment bonds, which are completely different. Property, either commercial or residential. If you own your own home, you are already heavily invested in property. Advantages: usually rises with inflation, unlike cash and bonds. Both income and capital growth possible from commercial or buy-to-let. Buy-to-let has tax advantages in the UK. The interest on the mortgage is tax deductible. Commercial properties are usually long-term lets on a full repair and insurance basis. The tenant is on the hook for all costs. Disadvantages: Costs of acquisition are very high. Legal fees, surveys and stamp duty. Costs of selling are also high. Costs of upkeep can be very high, repairs and maintenance. Property taxes are high, which hurts during void periods. Insurance costs and management costs are high, for example, letting agencies. Bad tenants and void periods diminish returns. Rising interest rates or fall in demand can give large capital losses. May be very difficult to sell in a downturn. Property is usually a long-term investment. The practice of flipping only works in very favourable market conditions, which can turn overnight. Property is viewed as medium risk and offers good income and reasonable long-term capital growth prospects. In the UK, it is heavily influenced by government policy, which may be good or bad in the longer term. Equities. These are shares in companies. Normally regarded as high risk, they are volatile investments. However, historically they offer very good growth prospects over the longer term and they can pay dividends. Investors can therefore focus on growth, income or both. Advantages. Strong track record of growth and shares also tend to rise with inflation as companies can put up prices of their products. Potential for income and growth. You can diversify geographically or across sectors. Almost unlimited choice. Usually liquid and easy to sell with fairly low transaction costs. Can use capital gains tax allowance. Disadvantages. Volatility. You can be down 20% just as easily as you can be up 20%, so they are not for the faint-hearted. Both gains and income are taxable, so you may need to invest in a tax-efficient wrapper which carries extra costs. Disposal may be tricky when market conditions are poor. You are in for the long term, or you may realise capital losses if you are forced to sell. In general, shares in companies are high risk in the short term but offer real growth potential and high returns are possible in the long term. They are one of the few ways you can invest in certain sectors, for example technology and media. Older investors will begin selling off their shares as they approach retirement and move into less volatile asset classes, such as bonds and cash. OK, let's look at the minor, but no less important, asset classes starting with commodities. These include gold, silver, copper, oil and gas, coffee, wheat, sugar, water, anything that is consumed. They are characterized by very high volatility, price bubbles and crashes. They are not suitable for most people. They do well when economies are growing and consumption is high and are a good hedge against inflation. There is scope for capital appreciation and loss. They do not pay an income, so there is no yield. Can now be easily traded via ETFs. They probably represent speculation more than investment, but a diversified portfolio could have an allocation to commodities. Some of them represent a store of wealth, for example precious metals, which represents insurance against market turmoil and unforeseeable events like war and currency crashes. Many people believe they represent true money, as opposed to paper money, which is just a promise to pay the bearer and has no inherent value. Foreign exchange. High risk and probably for short-term speculation, not long-term investment. There is scope for capital appreciation if you time the market well. Very few people can do this. Famous for carry trades. Borrowing in a low-interest currency to buy a currency paying a higher rate of interest and pocketing the difference. Currencies operate highly liquid markets and very low dealing costs. Currencies tend to move with global events and the release of key economic data, therefore it is a transparent market. Unfortunately, this has not been helped by the rigging of these markets by the large banks. Forex is really for high-risk speculators trying to time markets, although a diversified portfolio could have a small allocation of different currencies. And finally, alternative assets, which we prefer to call physical assets. These include works of art, stamps, coins, gold bullion, fine wines, rare and collectible objects. Many seriously wealthy people like to hold these because, unlike cash, they cannot be printed by government. They have good prospects of capital appreciation over the longer term and good defensive qualities. They can be hidden or stored in safe countries and are difficult to tax. Because they are physical objects, they have to be protected from damage or loss, so there may be insurance and storage costs. There is usually no yield from these. Again, it is not uncommon for many people to allocate a small percentage of their portfolio to precious metals and art as purely defensive measures against currency collapse and government wealth taxes. That's all we want to say about asset classes. It's important to understand their relative risks and why you might want some of them in your portfolio. Now look at our videos on compounding and investing in funds, that is, working with financial advisors to get the most from your money. Don't forget the importance of tax wrappers, which can make a big difference to the outcome. I will cover process, regulation, risk, strategic asset allocation through multi-asset funds and rebalancing in the next video. Thank you for listening.